Welcome to the ClientWise monthly update webinars. This is the one for January 2016, and we're doing it a little early because the extender bill got passed and there's quite a bit of information we need to get out. So this is going to be primarily the extender bill today. So my name's Lee Reams. I'm the Chief Technical Officer and a seminar speaker for ClientWise. And this course is going to give you 1 hour of CPE credit if you choose to take it that way. So if you are going to get the CPE credits, you need to keep track of the polling questions that we give them to you, because we're going to give you a small exam at the end with 3 questions, and you just have to answer the 3 questions correctly, and we're going to give the answers, so that should be an easy thing to do. That'll occur at the end of the presentation. You should have downloaded the PDF for this course. It's quite extensive, I think 14 pages or so, and it includes all the important changes that apply to individuals and small businesses that have been included in the tax extender bill. So if you haven't done that, you should stop and get that, and then return and follow us through as you go here. That PDF is available in the additional reference tab in the same place you entered into to sign up for this webinar. So, okay, so questions. If you have questions during the presentation, you can email those to cpe@clientwise.com, and we will respond to those as quickly as possible. One of the first issues you want to cover in the material is the 1099 miscellaneous filing issues. Although this has nothing to do with the extender bill, we have put together some material for you that I think you may find interesting and want to use. So first of all, the penalties were increased for 2016. So for 2016 filings, that's the 2015 filings are being done in 2016. The penalties have increased by twofold: $250 for each informational return that is not filed, up to a maximum of $3 million. If the payer's gross receipts for the year don't exceed $5 million and the returns are filed late, but not later than August 1st, 2016, the penalty is reduced. So it's reduced to $50 if correct and filed no later than March 30th of 2016. That's the 30th day after the required filing date, or $100 for each one that's refiled after March 30th, but no later than August 1st of 2013. So don't forget this. Remind your clients that 1099s are required for everyone who has they've paid $600 or more during the year for services in the course of their business. And one of the big problems is most of them forget to get the W-9s ahead of time, so they don't have the information they need to give you, and then they end up thinking, well, they're not going to pay them more than $600, and they don't get that document, and then they turn around later and pay them again, and then go over to $600, then they got a problem. So kind of remind your clients of all of that stuff so they don't forget. Okay, so for 2016 due dates, they're changed slightly this year. Normally there's January 31st, you have to have the copy to the recipient. However, January 31st this year falls on Saturday, so the due date moves to the next business day, which is February 1 of 2016. And then the IRS filing deadline for the forms is normally the last day of February, and since this is a leap year, that due date is February 29th of 2016. So now, for those of you who want to be proactive with your clients, we've developed 2 things for you. Number 1, a letter that you can send them reminding them of their requirements, and you'll see that on the bottom of that page there. And then we also developed a PDF form with form fill fields so the clients can fill the data in and send it back to you so you can prepare the 1099s for them. So what we're recommending here is that you send this letter out to your clients either by mail or by email, preferably email, because then you can attach the PDF that they can fill. If you do it by mail, of course, a PDF, you'll just have to print it, and won't be fillable. But either way, it's just good practice to do that, and so I recommend that you consider that and benefit from it. Okay, so on page 2 is a copy of the 1099 worksheet. You can see it there. We couldn't attach it to the material because obviously we lose the form fills if we do that. So it's an additional download in the same place you downloaded the material for this course. You'll see a tab there labeled 1099 worksheet, and you can go there after the course and download the form. It's actually 2 pages, so it has close to 10 entries on a sheet. So okay, now the next thing we want to look at is the standard mileage rates changed. That happened last week, and notice 2016-1 came out, and you'll notice that the rates have dropped. The business rate is dropped down to 54 cents, down from 57.5 in 2015. Medical and moving is dropped from 23 to 19, and charity, of course, remains at 14 because that's fixed by statute. So you'll have those for your clients if they start asking you that question. All right, so next up is going to be the extender bill, and it's called Protecting Americans from Tax Hikes Act of 2015. That's similar to, I guess, the Affordable Care Act, where all the insurance is now affordable. Little in-house joke here. Anyway, so that they reached a bipartisan agreement, which is amazing. They extended some of the provisions. They made some of them permanent, which was quite a surprise, and they even modified some slightly. So we'll talk about all of those. And very interestingly, they added some new anti-fraud provisions to the law. So, okay, so let's take a look at the first one, and that's the child credit. And even though that was a child credit was permanent, they had some temporary provisions attached to it. And one of those temporary provisions was a $3,000 threshold that was the threshold where it kicked in, the credit kicked in. So let's take a look at this. So the child credit provides a $1,000 credit for each dependent child under the age of 17 at the year's end who lived with the taxpayer over half the year and meets the relationship test. That credit phases out at thresholds of $110,000 for married filing joint filers, and $55,000 for married filing separate filers, and $75,000 for all the rest of filing statuses. And the credit does offset the AMT. So there's 2 types of credits. One is a non-refundable, and one's a refundable. So the refundable portion is computed using either the method temporarily based on a lower earned income excess of $3,000. That's for 2009 through 2017, and it was $10,000 in the original statute. So, and then you could use the additional child credit for taxpayers of 3 or more children using Form 8812. Anyway, under the extended legislation, the enhanced credit created by the lower $3,000 earned income threshold is made permanent, but that value is not inflation adjusted in the future. They also added some program integrity provisions, which prohibits an individual from retroactively claiming the child credit. And I made a mistake there, that says AOTC, but that's what I get for cutting and pasting. So it's retroactively claiming the child credit by amending a return or filing an original return if he failed to file in the first place. So that's in which the individual or the student for whom the credit is claimed did not have an I-10. So in other words, if you didn't have an I-10 when you were supposed to file, you can't go back and then correct it. After 2015, a paid preparer is subject to the same due diligence requirements that apply to the Earned Income Tax Credit. I knew you'd all be happy to hear about that, including a $500 penalty indexed for inflation. So after 2015, now they also will penalize the taxpayer if he improperly takes the credit. So effective for after 2015. The legislation includes a disallowance period where no credit is allowed where the taxpayer improperly claims the credit. Based upon fraud or disallowance, the period is for 10 years. Reckless or intentional disregard of rules and regulations, not fraud, the disallowance is for a period of 2 years. Not quite sure how they're going to distinguish between what is fraud and what is reckless and intentional disregard, but I guess we'll find out when they get around to the regs. Okay, now let's take a look at the, don't take a look at anything, we're going to do the first polling question. And the answer to the first polling question is bear. So get your pencil and pad out and write down bear. You'll need that for your CE credit. Okay, now let's take a look at the American Opportunity Credit. So this credit was only applicable through 2017 and provided an education tax credit equal to 40% of the cost of tuition, qualifying expenses for higher education with a maximum credit of $2,500. The credit is based upon 100% of the first $2,000 and 25% of the next $2,000 of qualifying expenses. The credit is 40% refundable. It also phases out between $160K and $180K for married filing joint taxpayers and between $80K and $90K for others, except for married filing separate taxpayers don't qualify for the credit at all. Under the legislation, this credit is made permanent. It also, like the other one, like the child credit, it adds program integrity provisions which prohibits an individual from retroactively claiming the AOTC by amending a return for any year in which the individual or student for whom the credit is claimed did not have an I-10. So can't get the I-10, then go back and amend. After 2015, a paid preparer will also for American Opportunity Credit will be subject to that same $500 penalty for due diligence requirements. And they always like to throw it back on us, right? Anyway, and it also adds that same credit disallowance periods where the taxpayer claimed it when they weren't allowed to. So fraud and disallowance, the period is for 10 years. For reckless intentional disregard of rules and regulations, not fraud, the disallowance period is going to be 2 years. All right, so let me see. Next up we have the Earned Income Tax Credit. Now, so you'll understand, the 3 or more children provision in the Earned Income Tax Credit was only temporarily installed. So the original credit only had no children, 1 or more children, or 1 child and 2 or more children. And then a few years back they added this 3 or more children. Well, that provision has been made permanent. But we also find that we have the program integrity provisions, which you can't retroactively claim these if you didn't have an I-10 when you filed. And now you do get an I-10 and then you try to go back and amend or file an original return that's late. Okay, and they also reduced the marriage penalty for the Earned Income Tax Credit. They did this by increasing the income phase out by $5,000. It was $3,000. Now they're making it $5,000 for a married filing joint return. Okay, so next up we have the big deduction, the teachers above the line deduction. This is made permanent, and it's going to be inflation adjusted after 2015. And they did add to the allowable expenses the personal development expenses. I don't know why, since all teachers would have $250 no matter what they did anyway, so they get their above the line deduction. As a special note, remember now, you can also take these as a charitable deduction if the teacher has the right documentation for a non-cash charitable contribution. That means they've got to have the letter from the school and it's got to say all the right things, and you know what those are, but that's possible. So you might even think about having the 250 adjustment plus any excess they have can go under the charitable contributions, if they, of course, if they have to itemize to do that. Um, so let's take a look at the next provision. So next up is transit passes and charity parity. So what happens here is we had for several years the transit passes were set at 240 for qualified parking, but only 120 for transit passes. So this bill changes that to make it so it's they're both the same, and that permanent change going forward. Okay, the next is the optional deduction for sales taxes and state income tax. I can just imagine these hearings back in Washington where the senators and representatives from the states without any income tax, those were Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. I'm sure they were all lobbying for this big time, because without it, their constituents don't have any deduction at all, so because they don't have any state income tax. But anyway, so this legislation has been made permanent, so a person can elect to deduct either the state and local income tax or state and local sales tax. All right, let's take a look at the next one, which is the above the line tuition deduction. They made that retroactively extended, so it's good for 2015 and extended for 2016. So it's effectively just a 2-year extension. Again, this has limited benefit because you do have the American Opportunity Tax Credit, which provides a credit. So. Next up, we have the qualified conservation contributions. I'm sure not too many of you get involved with this, but I thought I would touch on it anyway. They were normally qualified conservation contributions would fall in the 30% of AGI category, but they temporarily put that in the 50% category, and now they've made that permanent. In addition, they've in the same bill they made the Alaska Native Corporation, it moved that up into the 100% category. So if you're an Alaskan taxpayer, you might be of interest to you. Okay, so let's take a look at the next provision, which is the tax-free IRA to charity contribution. A little background on that. That's an individual who's 70 and a half and in the required minimum distribution category, where he's going to start taking distributions, can transfer monies from his IRA, remember, or directly transfer to a charity, his contribution to the charity, and then that distribution is not included income, and that in effect lowers the AGI, which in turn helps to avoid various AGI phase outs and limitations. So it's a good thing to do. So keeping the AGI lower will also help to minimize the amount of the Social Security income that is subject to tax for some taxpayers. And taxpayers using the standard deduction can't get a charitable deduction anyway, but are essentially deducting the charity gift from the gross income by making contributions this way. So it's worked out pretty well. And the transfer distribution counts towards the taxpayer's required minimum distribution for the year. Now, you don't have a lot of time to take advantage of that for 2015, of course, but if you had listened to me in the seminar and you told your clients ahead of time to do this just in case it passed, then you will get some benefits. So anyway, under legislation, these charity transfers are made permanent. Okay, next issue. Okay, discharge of qualified principal residence indebtedness. Now, this had originally expired first in 2013, then in 2000, and they extended it to 2014. And then everybody's been sitting around waiting to see what's going to happen for this year, and they have now extended it through 2016. So those of you who are hoping that you'd find out about this before you had the October 15th filing date, and where you had to file returns, are now stuck with going back and doing an amended return if your clients will qualify for this. So remember, if somebody sells their home or has their home foreclosed upon or has a short sale, and they have cancellation of debt income, there's only two ways out of it. That's with the insolvency exclusion or the discharge of qualified principal residence indebtedness. But that qualified principal residence indebtedness only applies to the COD income from discharges of acquisition debt and not equity debt. And equity debt is considered first. So if you may run across cases where you can use both these exclusions. Use the insolvency first, and then see if you can get it down to where the rest of it's qualified principal residence indebtedness, and then maybe you can discharge it all. The other main category for this is the HAMP loan modifications, which will actually discharge part of the debt, and the taxpayers will get a 1099-C for cancellation of debt income. Generally, these people are probably not insolvent because they still hold a house. They don't, which would help them qualify for insolvency. But since they still have the house, they probably don't. So this will help those because they can discharge this debt, this HAMP loan modification debt, COD income, using a qualified principal residence indebtedness. Okay, so let's take a look at the next one coming up here. Mortgage insurance premiums. A little background on those. Those for tax years 2007 through 2014. Taxpayers could deduct as an itemized deduction under the mortgage interest category the cost of premiums for mortgage insurance on a qualified personal residence. The premiums are deducted as a home mortgage interest on line 13 of Schedule A. To be deductible, the premiums must have been paid in connection with an acquisition debt. The mortgage insurance contract must have been issued after December 31st, 2016. It must be a qualified residence, first or second homes count. The deductible amount of the premiums phase out ratably by 10% for each $1,000 in which the taxpayer's AGI exceeds $100,000. Half of those amounts for married filing separate, and 10% for each $500 for married filing separate that exceeds the $50,000. The qualified mortgage for this deduction is those with the Department of Veterans Affairs, Federal Housing Administration, Rural Housing Services, and private mortgage service insurance as defined in Section 2 of the Homeowners Protection Act of '98. So anyway, under this legislation, this is retroactively extended through 2016, so your clients can take it in 15 and 16, and that will probably be the end of it. Okay, so research credit has been retroactively made permanent, and it provides a credit up to 20% of qualified expenditures for businesses that develop, design, or improve products, processes, techniques, and formulas, or software and similar activities. This credit's been around since 1981, and it's never been made permanent by Congress until now, and it's always been extended year after year. Anyway, under the legislation, the credit now is retroactively made permanent. In addition, it is not a tax preference for small businesses. So for years after after December 31st, 2015, small businesses, those with $50 million or less in gross receipts, can claim the credit against the AMT. And then also, for years after December 31st, 2015, small businesses, those with less than $5 million in gross receipts, can claim up to $250,000 per year of the credit against their employer FICA tax liability. That's a sweet little benefit there. So anyway, okay, now that's covered in chapter 9.16 in the big book. However, I left it out of the seminar text, so and all the text that got mailed out. We will restore that to the digital and the online versions as soon as we can get through all of these and make all these changes. All right, so let's take a look at the next one here. We have a qualified small business stock. So that currently there's a 100% exclusion for the gain of a stock, qualified business stock issued after 9/27/2010, and that's made retroactively permanent. So it's a great benefit. No AMT preference, and applies to the 100% exclusion. So taxpayer gets out stock free. Now remember, there are other categories. There's a 50% exclusion, and they have a 7% AMT adjustment, and for a while we had, I think, a 75%. So, but remember, those issues still come into play because those stocks had to be held for 5 years before they can take this exclusions. So whether it was a 50%, a 75%, or 100% exclusion, they still have to wait out the 5-year period for this applies. But at any rate, under this current legislation, it is made permanent. Okay, next one is enhanced deduction for food inventory. I don't know how many of you deal with restaurants or small grocery chains or whatever, but through 2014, taxpayers were allowed a deduction for contributions of food inventory. C Corporation could deduct the lesser of the basis plus half the property's depreciation, or twice the property's basis, for contributions of food inventory that was apparently wholesome food. For taxpayers other than C corporations, the deduction for food can't exceed 10% of the taxpayer's aggregate net income for the tax year from all trades or businesses from which the contributions were made for that year. So if it happens to apply to you, that's been made permanent. Okay, now we've just come to our second polling question, and the answer to that question is Rio Grande. It's the River Rio Grande. So if you write that down on your pad of paper, and then we'll move on. Okay, so next up is differential wage payment credit. Now, through 2014, an eligible small business, and that applies to a business with 50 or less employees, they could pay the differential wage to an employee and get a credit for it. Now, the differential wage is for an employee who goes into military service, and he's going in for greater than 30 days. If the employer is nice enough to pay him the difference between his military pay and his work pay, the employer gets a credit for that. The credit's equal to 20% up to a maximum of $20,000 of differential pay, and for the employer during any tax year. So this is made permanent. In addition to being made permanent, after December 31st, 2015, it applies to any size employer, just not limited to those with less than 50 employees. Okay, next up, work opportunity credit. This credit, this little background here, you get a credit of 40% of the employee's first year wages, and the wages not exceeding $6,000. So the maximum credit is $2,400. So that's 40% of the $6,000. The credit is reduced to 25% for employees who have completed at least 120 hours but not less than 400 hours of service for the employer, and no credit is allowed for an employer who has worked fewer than 120 hours. Now they also, in addition to retroactively extending this through 2019, they did this 5-year extension so it would apply to veterans and non-veterans as well. And the legislation also added qualified long-term unemployment recipients to the list of targeted groups. But that's effective for after December 31st, 2015. All right, let's move on now to Section 179. Since 2003, the Section 179 election has been temporarily increased from its statutory limit of $25,000. And if you're a California tax preparer, you know that California still goes with the old $25,000. Anyway, these temporary increases have ranged from $100,000 to $500,000. But since 2010, the expense cap has been $500,000, with half of that for a married filing a separate tax return. And the investment limit has been $2 million. However, that last extension for the $500,000 had expired after 2014, and would have returned to $25,000. The old statutory limit in 2015 had not they extended this. Now, the Section 179 is covered in Chapter 3.06 of the Big Book of Taxes, and you get a lot more detail there. And in fact, I was in the process of updating that chapter just today, so we'll get that out as quickly as possible. Okay, anyway, under the legislation, the statutory limit of $500,000 is extended after 2014 and made permanent, which is a big boon for taxpayers. The investment limit of $2 million is extended and made permanent also. And then after 2015, the dollar limit, the $500,000, and the investment limit will be inflation adjusted. Now the election for Section 179, originally had been modified. It used to be irrevocable, but then when they made these changes to the larger Section 179 deduction, they relented and made it revocable without any consent of the IRS. However, once made and revoked, it becomes irrevocable. So you gotta be careful here. Okay, so now Section 179 also applies to off-the-shelf computer software. So the ability to apply it to off-the-shelf was made retroactively permanent. So from now on, you can always apply the Section 179 to off-the-shelf software. Qualified real property. So for several years here, we've been able to apply the Section 179 to qualified real property, which is defined as improvements to qualified leasehold property, qualified restaurant property, and qualified retail improvements. That's been extended and made permanent. In addition, the $250,000 expense limitation and carrier limitations have been removed. Before you could only use $250,000 for the 179 for any of these categories. Now that limitation is removed and there's no limit. And interestingly enough, they added air conditioning and heating units to be treated as eligible for expensing after December 31st, 2015, and they were always explicitly not allowed. So that's quite a little change there. Okay, qualified leasehold, retail improvements, and restaurant property. Remember in class I was talking about who cares about some of these changes. Well, this is an interesting one because if they didn't extend this, the class life would have gone to 31 years, but luckily they did extend it so that it's permanently included in the 15-year class life, maker's class life category. All right, next one up is bonus depreciation. The bonus depreciation started all as a way to stimulate the economy back in 2008 when when the economy was in big trouble, and they put in a 50% bonus depreciation, and then subsequently extended that clear through 2014, and even at one point between September 8th of 2010 and January 1st of 2012, it was even 100% bonus depreciation. Now, bonus depreciation applies to personal tangible property placed in service during the year for which the original use began with the taxpayer. Chapter 3.04 of the Big Book of Taxes includes a lot of detail on depreciation and bonus depreciation included in that chapter. So now, as a side benefit from the bonus depreciation in the past, we've had additional $8,000 added to the first year luxury auto limits for 2008 through 2014. And it also applied to qualified leasehold improvements property for 2010 through 2014. However, under the legislation, the 50% bonus depreciation is extended for 2 years for property placed in service before January 1st, 2017. In other words, it's through 2016. Generally applies to property with a class life of 20 years or less, and the provisions also apply to qualified leasehold property, interior improvement, qualified improvements to non-residential property after the building has been placed in service, and the 50% bonus depreciation applies to plants bearing fruits and nuts that are planted or grafted before January 1st, 2020. And also the choice by a C corporation to forego bonus depreciation and claim AMT is also extended. All right, next up we have an interesting provision here. As I just got through mentioning, for the years that we had the bonus depreciation, the first year luxury auto limit was always increased by $8,000. Well, even though the bonus depreciation has only been extended for 2 years, they're extending the first year bonus for cars and trucks in 3 categories here. So they're going to for 2015 through 2017 they're going to leave it at 8,000, and then for 2018 they're going to start phasing it out, drops down to 6,400, then 2019 it drops to 4,800. All right, so this next up is a residential energy credit, section 25C. Everybody gets these mixed up. There's a credit 25D and 25C. 25D is a solar credit. It gives you 30% credit for solar, geothermal, and wind energy. But this is the lower one. This is the one that has the $500 credit for making energy saving, that's the best way to put it, energy efficient or energy saving modifications to the taxpayer's home. That is retroactively extended through 2016, so it means it's good for 2015 and 16. They did add some Energy Star compliance requirements, and they're in the material there. They have to comply with version 6 of the Energy Star program in the cases of exterior windows and skylights and exterior doors, and also continue to comply with the American Recovery and Reinvestment Tax Act of 2009, which had International Energy Conservation Code was included in that. Now, the credit remains to be a $500 lifetime credit. Now, remember, back a few years, you could get as much as $1,500 credit for this, and then they reduced it to $500. Then they made it a lifetime credit. So be careful when you look back and make sure your client hasn't taken this previously if you're going to continue to take that. Okay. Next up here we have the credit for building new energy efficient homes. And this credit is primarily for contractors. And they've retroactively extended that through 2016. So the credit provides a building contractor with a credit of $2,000 for site-built homes and $1,000 or $2,000 for manufactured homes that meet certain energy-saving requirements. The saving requirements are generally 30 to 50% for manufactured homes and 50% for site-built homes. And an envelope, building envelope providing reduced heating and cooling energy consumption of at least 10%. This was scheduled to expire at 2014, and they've extended it through 2016. Now that the details of that are in the Big Book Chapter 9.12. However, I left that out of the text this year, thinking that it would not get extended, and it has. So I will update it and restore that to the digital and online versions of the text. Okay, the next one we have another one here, the energy efficient commercial building deduction. So through 2014, a deduction was allowed in an amount equal to the cost of energy efficient improvements to the lighting, heating, cooling, ventilation, and hot water systems of a qualified commercial building placed in service during the tax year. The maximum deduction was the excess, if any, of the product of $1.80 and the square foot of the building over the aggregate amount of the deductions for the building for all earlier tax years. So anyway, this credit has been extended through 2016 and will benefit the people with commercial buildings. Okay, then credit for fuel cell vehicles. That's next up here. So for 2014, a taxpayer could claim a credit for vehicles fueled by chemically combining oxygen and hydrogen and thus creating electricity. Generally, the credit was $4,000 for vehicles weighing 8,500 pounds or less. That's the luxury auto category. And up to $40,000 for heavier vehicles depending upon their weight. An additional $1,000 or $4,000 credit was available to cars and light trucks to the extent their fuel economy exceeded the 2002 base economy set forth in Code Section 30B. At any rate, under this legislation, the credit is retroactively extended for 2 years through 2016. Okay, now next up we have the W-2, W-3, and non-employee contribution statements. Now what we have here in the next three items we're going to talk about is an issue where the Internal Revenue Service is trying to put a cap on fraud. So to do that, they've come up with these three issues here that we're going to talk about. So for W-2s and 1099s, effective for the 2016 filing year, that's the filings, that's for the tax returns for 2016 being filed in 2017. The filing due date for W-2s and 1099 miscellaneous is being moved up to January 31st. That's the filing date. Not just getting the copy to the employee. That's the actual filing date. So this is something to prepare for. It's a year away, but something to keep in mind. And then combined with that, beginning in 2016 filing season, that would be in 2017, refunds included that include the refundable child credit or EITC will not be issued until February 15th or later. So your clients are going to think they're going to get their run-in early, do their e-file, and get their refund really early, maybe in for a surprise. And what they're trying to do, is to cut down the fraud. So they want to see the documents that are included in the W-2 and 1099-Cs all hitting the IRS's computer, and then they can better determine who qualifies for these credits electronically and deny them if they're trying to get them fraudulently. So anyway, we'll see how this works out. It's a year away. It might change a little bit by the time that rolls around. Okay, and then they also came up with a de minimis safe harbor for 1099s. So the de minimis safe harbor for informational returns where no single amount reported, the amount differs from the correct amount by $100. So you can be off by $100, and that's considered a de minimis safe harbor. Or the tax withholding differs from the correct amount by $25. That's also a de minimis safe harbor, so you wouldn't be subject to a penalty. And then they go on to say in which case the returns will be treated as filed with the correct information and no correction is required except where such error relates to an amount with respect to which the election is made under section 6722C3B. So they're all tying this into trying to stop a lot of fraud that's been going on, and we'll see how that works out. Something to look forward to in 2017, when we file returns for 2016. Okay, so now there's some other provisions, and they're included here in the handout material. I'm going to kind of go through those. So the new markets tax credit, that's section 45DF, been extended through 2016. The mine rescue team credit extended through 2016. I mean, some of these you probably don't care about, but we're going to talk about them anyway just to make sure. Certain racehorse property is as 3-year property. That provision has been extended through 2016. The Indian employment tax credit has been extended through 2016. Motorsports entertainment complexes write-offs and depreciation extended through 2016. Accelerated depreciation for property on Indian reservations modified and extended through 2016. Now, whenever I say modified, that means that you may want to go back and look at that if this impacts you, because they just didn't extend it, they also modified it. Okay, then we have special expensing rules for certain film and TV productions. Again, that was modified and extended, so if it applies to you, go back and check out the details on the modifications. Empowerment zone tax incentives, again, that was modified and extended through 2016. And a hot issue we heard a lot on the news about is the medical device excise tax. That was modified by suspending the tax on the medical devices from January 1, 2016 through December 31st, 2017. I guess that'll give them a time to hash it out back there and figure out what they're actually going to do. Alternative vehicle refueling property, that's section 30C. That's been extended through 2016. That is included in one of the chapters of the big book. I did drop it out of there because I didn't think it would get extended, and it did, and I'll add it back. The two-wheel plug-in electric vehicle, that's for motorcycles, I guess, extended through 2016, and again I dropped that out of the big book and I'll put it back. The energy efficient commercial building deduction, we just got through talking about that a second ago. And then we had the credit for new qualified fuel cell motor vehicles. I did talk about that previously. I will add that back to the big book of taxes as well. And then they have some special rules relating to the issuance of ITINs. I didn't provide any detail here because that's something that's going to take a lot of room, and for an hour CPE we don't have time to do that. And then the charitable contributions to food inventory, we already talked about that. And then the reduction of S corporation recognition period for built-in gains tax, that's retroactively and permanently extended. And then we have a lower shareholder basis adjustment for charitable contributions by an S corporation. That's been retroactively and permanently extended. And the special rule for payments to a charity from a controlled entity, that's been retroactively and permanently extended. Now that's the list I have here in the handout, but remember there are still more, but they're for bigger companies and utilities, and so I didn't really get involved in that. So now the one thing that's notably missing I'd like to bring to your attention, and that is the solar energy credit. It's actually called a residential energy efficient property credit, which is actually solar credit or wind credit or geothermal credit. And it provides a non-refundable credit of 30% of the cost of the equipment and the installation costs. And although this credit is very large, it is also non-refundable, and any carryover is good only up to the sunset date of the credit. Now, what troubles me here is they did not extend this one. They did another one. They did the AOTC, which is going to expire in 2017. They extended, but they didn't extend this one. So I don't know what their thinking is, but I want you to consider this when your clients are getting marketed like crazy for solar, and the people who are selling it are touting this big credit, right? 30% credit. So, but remember, it only offsets. It's non-refundable. It only offsets the tax, and it only carries over as long as this credit is available. So if you had carry over from 2015 to 2016 and you didn't use it all in 2016 and the credit expires in 2016, nothing carries over to 17. So something to think about here. So be careful with your clients. Make sure they understand all this. Okay, now here's the last polling question. It's Indian. So write that down on your pad. Okay, if you got that, then I jumped ahead on this Section 25D credit, so that slides out of place. But anyway, I think we've come to the end of the webinar. So in order to get your credits, you need to go on back on our website, answer the polling test questions, and you'll immediately be able to print out your CPE certificate, which will be available to print in the Recent Achievements tab, or if you take a lot of CPE from us in your Achievements folder. See, it's the trophy icon. And I want to thank you all for joining us. We scrambled quite a bit to get this out as quickly as possible. So as you know, I had a couple of typos in here, but I hope you'll forgive me for that. And we look forward to seeing you next time. Take care and have a good day. Bye.